Hello everyone, and welcome back to the channel. Today, we're diving deep into the glittering world of gold. It's been a wild ride, hasn't it? Just a few weeks ago, gold was the superstar of the financial markets, soaring to incredible jaw-dropping highs. We saw it climb north of 4,300 United States dollars an ounce. That's not just a big number. It was an all-time high, marking a nearly 50% gain since the start of the year. Investors were cheering, and the headlines were buzzing. But then, just as quickly as it rose, boom, the price pulled back, and it pulled back hard. It broke through several key support levels, leaving everyone with one big question. Is the bull run over, or is it just taking a much-needed break? Let's unpack this together. So, what exactly caused this sudden retreat? Why did the golden rocket seem to run out of fuel? There are a few key factors at play here. First and foremost, simple profit-taking. After such a blistering, non-stop run-up, it's only natural for traders to want to lock in those fantastic gains. Think about it. If you saw your investment jump by nearly 50%, you'd be tempted to cash out, too. This selling pressure from profit-takers was a major contributor to the pullback. Second, there was a noticeable shift in market sentiment. We started hearing whispers of optimism, particularly around a possible trade deal between the United States and China. When big economic players start talking and potentially resolving conflicts, it reduces the overall sense of uncertainty in the global market. And when uncertainty fades, the desperate need for safe haven assets like gold also tends to decrease. Investors felt a little safer, so they moved some of their money out of gold and into other assets. Third, the technical indicators started flashing warning signs. For those who followed charts, gold broke below its short-term moving averages, which is often seen as a bearish signal. On top of that, the momentum, the sheer force that was pushing the price higher and higher, began to cool off. The combination of these technical signals told traders that the upward sprint might be losing steam, prompting even more selling. So, it wasn't just one thing, but a perfect storm of profit-taking, improving market sentiment, and technical red flags that triggered this correction. Now, let's put on our analyst hats and zoom in on the technical side of things, because the charts are telling a fascinating story. After the sharp drop, gold prices found themselves testing some critical support zones, specifically around the 3,950 United States dollars to 3,900 United States dollars range. A support zone is like a floor. It's a price level where buyers have historically stepped in to prevent the price from falling further. The fact that gold is testing this area is crucial. If the price breaks below this floor and fails to hold it, the next level of support might be down in the 3,850 United States dollars region. Some analysts are even suggesting that if that level gives way, we could see a slide all the way down towards 3,500 United States dollars in the near term. That would represent a significant correction. But what about the upside? If gold manages to bounce back, where is the resistance? Resistance is the opposite of support. It's a ceiling where sellers tend to emerge and stop the price from rising higher. Right now, we're seeing a stack of resistance building up around the 4,041 United States dollars to 4,100 United States dollars area. This brings us back to the $1,000,000 rule. Perhaps the 4,000 $N-ounce question, is the bull trend dead? Well, not necessarily. Many experienced market commentators are arguing that this pullback is actually a healthy and necessary consolidation. Think of it like a marathon runner taking a short water break. It's not a sign of giving up. It's a reset before the next leg of the race. A market that goes straight up without any breaks is often unsustainable and prone to a much more dramatic crash later on. This correction helps shake out the speculative excess and builds a more stable foundation for future growth. Plus, the fundamental reasons for owning gold haven't disappeared. The long-term tailwinds are still there. We're still seeing central banks around the world buying gold to diversify their reserves. Concerns about inflation are still very real, and gold is a classic hedge against rising prices. Worries about massive levels of sovereign debt in major economies also push investors towards the perceived safety of gold. These are the traditional engines that power a gold bull market, and they are still running in the background. But then this is a very important but. The pace of buying needs to continue, and we can't ignore the broader macroeconomic picture. Things like U.S. interest rate decisions, the strength of the U.S. dollar, and any new geopolitical risks will continue to play a huge role in where gold goes next. So, for all of you watching, whether you're already holding gold or you're thinking about getting in, here's what you need to keep a close eye on. And what if the price gets stuck in between those two levels? Well, get ready for some range trading. We could see the price bounce back and forth, consolidating sideways for a while as the market tries to figure out its next direction. The key message here is to not panic just because you see a pullback. Corrections are normal, but at the same time, don't be complacent and assume that the ride will always be smooth and easy. It's a time for caution and careful observation. So, to wrap it all up, what's the bottom line? The gold bull isn't dead. It's more likely just catching its breath. This pullback is giving the market a valuable opportunity to reset, to shake off some of that overheated momentum, and potentially set the stage for the next leg higher. However, the situation is delicate. If those key support levels we talked about start to crumble, our narrative could shift from a healthy correction in a bull market to a major trend under threat. It's more important than ever to keep your eyes sharp. Pay attention to the signals the market is giving you, and maintain tight risk control on your positions. Because in the dynamic and often unpredictable world of gold, the biggest and most exciting moves often follow a period of calm. Thank you so much for joining me today for this analysis. I hope you found it helpful. If you did, please give this video a thumbs up, and do not forget to hit that subscribe button and ring the bell so you won't miss any of our future updates. I'd love to hear your thoughts in the comments below. Until next time, trade safe and stay informed.